So today we're going to start the options topic. It is kind of a complicated topic. So today I will go step by step and I will go very slowly over the material. I will probably cover the first 60 slides or so. And then Thursday we're going to go into more complicated stuff. So if you don't understand anything, stop me. There are no stupid questions, okay? So feel free to ask whatever question you have. Okay, so what are we going to do is about options. So I will introduce you the basic terminology, and then we will talk about the payoffs and profits related to options. And today we will have time to cover, to understand put-call parity and how we can find the price of a put option from a call option or things like that. And Thursday we're going to look at the binomial and Black-Scholes pricing of options, which got them a Nobel Prize. So it's kind of an important thing. Okay, what is an option? I will explain it with an apple example. I don't have an apple now, but suppose that I own an apple and you own a piece of paper, which is actually a call option. And this paper is giving you the right to buy this apple from me for $1. The price of an apple in the store is 75 cents. If it is the case, would you use that piece of paper and buy that apple from me for $1? No. The animations don't work for some reason, so the answer is there, but just focus on me. Yeah, there should be an animation here, but it doesn't work for some reason. So in that case, it doesn't matter. It doesn't make sense for you to buy this apple from me for $1, right? What if the apple price was $3 at the store? You have that paper, so you would exercise this option, the terminology, you would exercise that piece of paper and buy this apple from me for $1. And then you can either sell it at the store or make another investment. But you're basically making money on that, right? So this is the option intuition. That's it. Not very complicated, right? So what is an option in finance world? An option is an example of a derivative. An option can be written on a security. It can be a stock, it can be a bond. Generally, I will say stock for simple reference, okay? So it's a contract that will give the option holder, the buyer of the option, the right, but not to obligation, to buy or sell a stock at a predetermined price at a date in the future. So in that piece of paper, you're going to know how much is the price that you can exercise the option from. Of course, it needs an expiration date. I cannot give you that option for a very long time, right? It will have an expiration date on it. And you will have the right to exercise the option or not. Just like in the apple example. You can exercise the option, buy the apple from me, or not exercise the option, okay? And there are two types of option, the big types of option. From those options, we are going to create different options as well. There's a call option. Like in the apple example, it will give you the right to buy the stock from me. It's a call option. Put option will give you the right to sell a stock to someone else. Okay? So again, it's not an obligation, it is just a right. So as an option holder, you're pretty flexible. You're going to decide whether you're going to exercise the option or not. Clear, right? I think so. More terminology. There are two parties. There is the option holder, who is the buyer of the option. This person has more flexibility. This person will decide whether he wants to exercise the option or not. So he has a long position in the contract. Additional terminology. Option writer is the seller of the contract, seller of the options. But whenever the option holder wants to exercise his option writer cannot say no. So whatever the option holder wants, option writer has to go with it. And the option writer, the option seller, has the short position in the contract. Is the seller. More terminology, okay? The option holder, the buyer of the option, can exercise the option if he wants to buy or sell the stock at the predetermined price before the expiration date. The strike price or exercise price is the price that is written on the contract, and it's the price the option holder will buy or sell the stock from the option writer. In the Apple example, it said $1, for instance. $1 was the exercise price or the strike price. So it is the price you need to pay if you want to exercise the option to buy the Apple from me. Option premium, of course, like this is a trading activity. I'm the option seller, option writer, you're the option holder. I'm selling that piece of paper for a price. Otherwise, it would be stupid of me to give you some flexibility on it. So the price of the option is called option premium. It's the price. The expiration date is the date on which the option, it's the last day option holder can exercise the option. And generally, an option is a contract that gives you to buy or sell the 100 shares, 100 of that financial security. So again, not very difficult, I think. Any questions here? Just terminology. Okay. Let's continue. A little more terminology. There are two types of options. American options or European options. European options can only be exercised at the expiration date. Not before, definitely not after, but at the expiration date. American options can be exercised on or before the expiration date. But in general, people wait till the last day, the expiration date, to exercise the option. So we're going to treat all the options like a European option. Another thing is, this American or European thing has nothing to do with the location. Okay, so a US option can be in the form of a European option. It's just about when can you exercise the option. That's it. Okay, so it has nothing to do with US market or Europe market. It's just, I don't know why it's the terminology. Okay. Okay. A little bit more. So let me ask you, if the strike price of a call option, remember, call option gives you the right to buy a security from me. I'm the option writer. If the strike price in the option is higher than the price in the market, would you exercise the option? No. In that case, this option is called out-of-money options. So since the call options where strike price is greater than the market price, it doesn't make sense for you to exercise the option because you're paying more than what the market value is. Those kind of options are called out-of-the-money. In the put option case, so put option gives you the right to sell a security. In that case, if strike price is higher than the market price, would you exercise the option? Yes, because you're selling the stock at a higher price than the market value. In that case, we're going to call those kind of options in the money. So if it makes sense to exercise the option, those are in the money options. If it doesn't make sense to exercise the options, they're out of the money options. And at the money options, these are the options where strike price is equal to the market price. So you're indifferent. I mean, you can exercise the option or not. It doesn't make sense. It doesn't make a difference. Yes?
If it's in the money or the money options, what's in it for option writer?
The only thing that is in for the option writer is what? The price you paid to buy that paper from me. That's
There's
it.
an option premium, but it's in the out of the money case.
This is like sunk cost for you. And sunk cost, we're going to talk about the payoffs and you're going to see actually. So in the options thing, there's flexibility for the option holder. For me, the option writer, I don't have any flexibility. So the only thing I'm getting from this is, of course, the premium, the price you paid for that contract. That's it. Okay, so this is the last piece of terminology. So in US, stock options are traded since 1973 on Chicago Board Options Exchange. I'm going to go to that page in a second. By convention, all the expiration date for all the options are the third Friday of each month, or the Saturday, just after 5 p.m. It kind of becomes Saturday for trading purposes anyway. So it is the expiration date. One little piece of thing is open interest. It is basically the total number of contracts written on that stock and sold in the options market. So it's open interest. Okay, let's go how to interpret option codes. So here, this is the options for IBM. This is the price of IBM stock at that date, whatever the date is. These are the strike prices, exercise prices on the options. And these are the expirations, October, January, July. So different options with different strike prices and different expiration dates. Volume is basically the actively traded options in that particular day. It is different than open interest, but detail anyway. So here on the left-hand side, you see the call options. Here you see the put options. And this last is actually the price of the last price that options were traded. So we have here different price, different expiration date, different strike price options. So how are we going to look at these? So let's look at this one. This one is the one with strike price of 135. It expires on July. And on that date, the price of IBM stock was 138.25. In that case, would you exercise the option? Is it in the money or out of the money? It's in the money, right? Because you can buy the stock for 135 if you exercise the option. When this happens in July, of course. And the price is 138.25. So for this one, what are you going to do? What else do we have? We have a put option here with those, there are 2431 options traded for the put option. And this is the price of the put option. So what else do we have here? Okay, we said this call option is in the money. The difference is the 325. The difference between strike price and the price. And the put option here will be actually out of the money, right? For the put option, again, you're going to sell that option for 135 when the stock price is 138. So put option is out of the money. Call option is in the money, right? Okay. And what else do we have? Okay, we have, yes, we have, ooh, what's going on? Okay, so we have, something's happening here. Okay, so we have 2,300 call options traded that day. The price is what, 475? 475 for each option, but you're buying 100 shares, so you have to multiply with 100. So you're spending $175 plus some commissions to buy this option from Chicago Options Board. So for the put option, whatever this is, whatever the price is, okay, 0.81. So again, multiplied with 100. So you're paying $81 to buy this put option with some commissions. So this is how you're going to interpret, how you're going to look at the prices. Now let's go to the more real-world example. I want to look at the call option on Microsoft. So let's go to this. So, oops. Okay. So here, as you can see, on the left side, you can see the call options. On the right side, you see the put options. And here, I want to look at the ones which are closer to the price, because there's more activity going on there. And we're going to, later, we're going to see why it is the case. So for instance, if you look at this one, so this is the last sale price. This is going to, let's look at the April ones. Okay, let's look at here. Okay, so let's look at this one. So,
can you
zoom in? Okay. So this one, for instance, there's a particular option. Its strike price is 40, and the stock price was 40.5, if you remember. So this is the open interest available options in the market now. And the last sale price was 0.78. So it means you have to pay $78 to buy this option. And it's gonna expire on April. So look at this one. This is right now and an at the money option. This is its price. This is if you compare it with today's price. This is right now in the money option. So as you can see, you can pick whatever you want. You can pick different expiration dates. The longer the expiration date, the more flexibility you're going to have. And there are different strike prices. The further away you move away from the stock price, today's stock price, then of course there will be less trading going on. These are riskier options, but riskier means it might give you higher return as well. Okay, so it's again up to you what you're gonna decide. But we're gonna talk about how all those factors affect the option prices. So when I look at this example, okay, the call premium was actually 83 cents. So it changed a little bit. Now it was around 70s. So what you do is you pay $73 to buy this option. It will give you the right to buy 100 shares of Microsoft stock for $40 per share, which is the strike price, before April 19, 2014, which is the third Friday of the month. So when this day comes, or just before that, whenever you think it is profitable to exercise the price, of course you're going to look at the stock price, then you can exercise it. Okay? So this is the basic idea of an option. Is this very complicated, you think? Huh? It's not, right? Okay. Also, when a couple of days ago I was preparing the lecture notes, and I spent some time on here. It is the same page, Chicago Board Options Exchange page, and there are very good teaching materials there, learning materials there. So one thing, I put one thing here just to give you the link actually, so you can spend time if you want. So how options are exercised. So this is what you do. So the call owner notifies the brokerage firm about the trade, and then the brokerage firm notifies Options Clearing Corporation. So there need to be, of course, some registration with this trade. And then Option Clearing Corporation just picks someone who is in the short position for a call in the same class, in the same series. Okay? So bringing demand and supply together, basically. And then the brokerage firm randomly calls one of its customers with a short call position, gives an assignment notice informing the customer that a call owner has exercised the right to buy. And then the last part is, of course, the stock transaction. The stock transaction happens. Brokerage firm gets some money for some commissions, and then the stock is delivered to the buyer. So this is how it actually happens in the US market. As I said, if you want to spend some time on that website, there are very nice little videos and quizzes and stuff. Okay, so let's look at the payoffs for options. So I'm going to look at option holders, option writers payoff for call option and put option. So again, I'm going to go step by step. So what happens is when a call option holder exercises the option, she or he will buy the stock from you at the strike price and sells at the market price. So the payoff the option holder has is basically different, is the difference between the stock price and the exercise price. So what's going to happen to the payoff? Whenever stock price is higher than the exercise price, the difference will be the payoff of the option holder. And whenever stock price is less than the exercise price, the option holder will not exercise the option. So the payoff will be zero, right? Is this clear? Okay. So if you want to see it in a diagram, I'm going to show you lots of diagrams today. This is called hockey stick diagram. Hello, Canada. Okay. Here, X is the strike price, and S is the stock price. So whenever stock price is less than the exercise price, the payoff will be 0. And whenever stock price is higher than the strike price, the difference between the price and the strike price will give you the payoff for the call option holder. Any questions here? Yes.
You don't consider commissions or something like that?
Yes, these are payoffs. When we talk about profits, I'm going to consider them.
I have one more question.
Sure.
When we exercise the option, do we get the stocks instantly or after?
Yeah, we just went over it. So the brokerage firm does it immediately, basically. Okay, so let's go. Let's look at a question with numbers. So if the exercise price is 720 for a call option, and if the stock price is 840, the payoff option holder will get is the difference between these two, which is 120. Again, these are payoffs, these are not profits. So just wait, we need to consider the price, of course, which is here. So payoff is different than the profit, okay? When we talk about profit, we are going to consider the option price. So it is almost same with the payoffs, but this time you're going to deduct the price you paid for the option for both cases. Whether you exercise the option or not, you paid the price to buy the option, right? Which is C for call option. So in this case, your payoff will decrease by the price you paid for the option. It's kind of sunk cost. Whether you exercised or not, that money got out of the pocket anyway. Okay. So this time, what's going to happen? Your payoff diagram will just go down a little bit by the amount of the premium, call premium. So if you pay $20 for the call option, so your profit will be this time. It's not going to be 120, the difference between stock price and the stock price and the strike price, but it's going to be deducted by 20 more. So this time your profit will be equal to 100. So this is real profit you're going to make on the options. Okay, so this was the call option part, call option holder part. How about the call option writer? You buy that option from someone. So options are always zero-sum game, okay? If you win, then the other person will lose. So it's trading anyway. So what's going to happen? This is just the opposite. So when you don't exercise the option, then I'm the option seller. I'm getting the price. That's it. When you exercise the option, my profit will be, it's going to be the difference between the option price, strike price, and the stock price. Plus, again, I'm getting the money from you. So this time, the diagram will look like this. So it is the same one. 720 is the strike price. Stock price is 840. $20 was the price you paid for the option. So if you don't exercise the option, this is my payoff, basically, as the option seller. And if you exercise the option, this is, again, my payoff. I'm going to lose 120 when you exercise the option. When you look at the profits, then actually I'm losing like 100, let's say, as the payoff, as the profit. So as you can see, it's just mirror image of each other. Whenever you exercise the option or not, depending on it, I'm gonna kind of make money or not, let's say. But keep in mind, the only thing I'm getting is the call price. That's it. And why am I selling this option to you? Why a person would sell a call option?
Because you assume that price will be lower than.
Exactly. So it's all about expectations. Options are, again, like in general, financial markets are affected by expectation a lot. But options are truly all about expectations. So I expect stock price to decrease in the future. In that case, I'm getting the money for the options. It's good for me. And you think that the stock price will increase in the future. So you think you're going to make profit. So that's it. So people with different expectations get together, basically. So this was the call option part. Let's look at this very simple example. How much must the stock be worth at the expiration in order for a call holder to break even if the exercise price is 50 and the call premium is 4? Break even means it should be at the money. So what are you going to do? The profit is stock value minus the exercise price minus the premium. So in that case, stock value should be 54. 50 is the exercise price, which should be equal to the stock price plus the premium, of course. Okay, so this was the call option part. Let's look at the put option part. So this time, the idea is just the opposite. So this time, which one is better for you? Stock price being higher than strike price or just the opposite? Remember, put option gives you the right to sell the stock. So at the strike price. So this time, what do you want?
Price will be lower.
Uh-huh. You want to sell at a higher price than the stock price, right? This is exactly the case. So P is this time the premium for the put option, the price you pay for the put option. So this is for the option holder, the person who bought the option. So whenever stock price is higher than the exercise price, then the profits you're losing is just the price you paid for the put option. You're not exercising your option. But when the stock price is higher than the stock price is less than the exercise price, then you're going to exercise the put option. The payoff you're going to get is the difference between these two. Of course, you're paying the price for the put option, so you need to consider it. So if you look at the diagrams, this is what you're going to see. So this is put option with the same exercise price, 720. So if the stock price is higher than 720, you're not going to exercise your option. If the stock price is less than 720, then you're going to exercise the option. You're going to sell the stock at 720, even if the market price is 600. So this time, it is good for you. You have positive payoff. If you want to look at the profit, of course, your profit will decline by the price you paid for the put premium. So normally, you were making 120 payoff, but you pay 20 for the put option. So your profit will be $100 on that put option. When you look at the, this is $30 put option. Sorry, I missed it. So I thought it was 20. So basically, your payoff, your profit will be $90. When you look at the case for the put option writer's profit, it is just going to be the opposite. So this time, this is the payoff. Again, when the put option is exercised, 120 is the money the option writer will lose. In profit terms, it will be $90. And if the option is not exercised, again, then you're just getting the money for the put option. That's it. So you're going to have something like this. Okay, so did you understand the basics of call options and put options? Any questions? Okay, so let's look at this example. Then I'm going to play with options a little bit. Let me just see where we are. Okay, what is your return on exercising a put option which was purchased for $100 with an exercise price of 85? The stock price at expiration is 81. So you are the option holder. In that case, what's going to happen to your option price, option return? Bakın. So exercise price is 85. The stock price is 81. So if you want to exercise this option, how much money you're going to sell the stock for? 85, right? You can sell the stock for $85. But the stock price is actually 81. But you paid $10 for this put option. So you need to consider it. So you're making $4 from the stock, but you paid $10 to buy the put option. So actually your profit is -6. Since this question asks you the return, for return, do you remember what do? We compare our profits with the price you paid for the investment. So the price you paid for the put option is $10. So your return is actually -60%. So you're losing a lot of money. Okay. So to sum up, what we can see about call options is, if the call is in the money, it is the case where your payoff will be the difference between the exercise price and the stock price. If the call is out of the money, it's worthless. So basically, the call value, let's write this. Call value will be equal to, so it's going to be 0, or it's going to be the difference between the stock price and the exercise price. And for the payoff, for the put option, it is just the opposite. If the put option is in the money, then you're going to make x minus x, x minus s. If it is out of the money, you're not going to exercise it. So this is the basic value of a call option and put option. Of course, we're going to see how much you actually make and how prices are calculated in a second. But let's continue with this. Before going to more detailed stuff, I want to go over this simple table. I know things you find most of those things very simple, but we're going to go into complicated stuff like very soon. Don't worry. So suppose that we are interested in the call values and put values for a stock with different stock prices, and strike prices is 30. So let's look at those call values. Whenever the stock price is higher than the strike price, you're going to exercise the option, right? Because you're buying the stock at the strike price. So in those cases where the strike price is higher than the stock price, you're not going to exercise the call option. So call value is 0, 0, 0. Then whenever stock price becomes higher than the exercise price, you're going to exercise the call. And the difference between these two will give you the call values. So it's 5 in this case, 10 in this case. For put options, it's just the opposite. You're going to exercise the option only when stock price is less than the stock price. So the put value is 10 when the stock price is 20. And put value is 5 when the stock price is 5. Other cases, you're not going to exercise the put option. So it is just a table representation of what we just wrote there. Okay, now let's play with options a little bit. But as a summary, this is what I want to show. So these are the profits, okay? So you're buying options. Their prices are $10. Stock price is $50. So when you sell a call, what's going to happen? You're selling a call, so you're definitely getting $10 when you sell the option, right? And whenever the stock price is less than the strike price, the buyer of the stock, the buyer of the option, would he exercise the option? Here, whenever the stock price is less than the exercise price, would they exercise their options? No. So in that case, you're just getting your profit from the price you paid, you got for the sale of the option. Whenever the person who bought the call from you exercised the option, which is this range, whenever stock price is higher than 50, then your profit will decline. The higher the stock price, the less profit you're going to make, of course. And remember, you don't have flexibility. Even if the price is 100, you have to buy that stock for $100 and sell it to the other person for $50. So it's a huge risk, but you're taking that risk, okay? So this is how the diagram will look when you sell a call. When you buy a call, this is what's going to happen. Again, it's just the opposite case. You're paying $10 to buy the call, so we're starting with minus 10. You're exercising the call whenever the stock price is higher than 50. So your payoff will increase with the stock price. Let's look at the put cases. When you buy a put, you're paying $10 and you're gonna exercise the put option only when stock price is less than the strike price, and your payoff will decline as you get closer to the stock price. And whenever stock price is higher than the strike price, you're not going to exercise the option. The only thing you're losing is the price you paid for the put, which is $10. I know, I know. Let's continue. The last one is when you sell a put. When you sell a put, you're making 10 bucks from the sale. This is the price of the put. Of course, from at this point, when the stock price is higher than 50, the person who bought the put from you is not exercising the option. So you're getting your 10 bucks, you're happy. But whenever this person exercises the put, you're basically losing money. Whenever the stock price is way less than the exercise price, then you're losing a lot of money. So this is the summary of everything we just saw. Now let's play with those a little bit. Okay, we're gonna combine those options. So we have very funny things actually. We have butterflies and things. Oh, very interesting. Okay, let's look at those. But let me see whether we have time. Okay, so let's start with protective put. And we're gonna look at profits, okay? In the protective put, you're trying to minimize your risk basically. So what you do is you buy a stock. When you buy a stock, your profit will increase as the stock price increases, right? So you bought the stock, and on top of it, you buy a put option. Its exercise price is 50, and you're gonna exercise the option. These are the payoffs, so we are ignoring the put premium. But you can consider it. It's fine. You already know it shifts the line up or down. So it's not very complicated. So you buy the put, and you're going to exercise the put only when stock price is less than the exercise price. And here, you're not exercising it. So together, what happens is, actually, at this range, you're kind of smoothing your payoff. So you're protecting yourself, actually, right? So in this case, so you're losing money because of the put, but you're making money because of the stock. So together, they're going to cancel each other. So your payoff will be actually fixed here. And when the stock price is higher than 50, then you're actually making money from the stock. So it's going to look like this. So as you can see, it's all about, options are real world instruments, and you can use them, you can buy them. And you can actually make lots of money if you understand the options really well. They're very risky, but there are things to decrease your risk. Like this is a protective put. Buy a stock, buy a put option, then you're kind of protecting yourself. Of course, we're talking about very simple cases here. The real world is more complicated. Okay, so this is protective put. If you look at the profits, let's say you buy the stock for $40 and you buy the put for 10 bucks. So the same thing, okay, we just adjusted the things a little bit. So your protective put will actually look like this. So what happens? If the stock price is less than 50, you kind of protected yourself from the loss you're going to make from the stock. And if the price is higher than 50, then you're making money on the stock anyway. So you're getting rid of the downside potential. Does it remind you something? This green line, do you remember? It looks like something else. Hockey stick diagram, buying a call. It's same with buying a call actually. Okay? So, okay. But of course, it was buying a call payoff diagram. Profit diagram was different. So this is actually better than buying a call, of course. Because for buying a call, this was the payoff. For the profit, what do you need to do? You're going to shift it down. So actually, there is downside potential. You're kind of losing money. So instead of that, you can just buy a stock and buy a put together. Did you follow what I just said? Good. Okay. Okay. There is covered call strategy. So in this case, what you do is you're buying a stock, again at $40, let's say, and you're selling a call. So when you sell a call, of course, call option will not be exercised when the stock price is less than 50. So you're just getting that $10 from the sale of the call. And after $50 case, then the buyer of the call will exercise the call option, so you will start losing money. But what's going to happen is, since you have the stock and you have a sold call together, you're basically kind of deducting, reducing your loss from the stock because of the call, because of the price you get for the call, and also you're kind of smoothing your profits after the point of 40, let's say. So this is, I don't know whether it makes a lot of sense to do it, but here again you're getting rid of lots of, if you don't like risk, you can do it, because if stock does well, you're getting lots of money, but if the call doesn't do well, you're losing lots of money. So doing this together will smooth out your payoff when the price is higher than 40. So this is the covered call. Any questions? Okay, let's take a break here actually, then we're going to look at more complicated things.